part of your question, which was, do I believe in the efficient market hypothesis? I believe that in the long run, security prices can sort of converge to their value. But I also believe that in the short run, they very rarely reflect it.
Hi guys, welcome back to the channel. My name is Dave and that is Mike Khouw. You might recognize him from his time on CNBC, but he's also decided to join up with YieldMax. So today I had the opportunity to talk to Mike all about YieldMax products, and also his general view on covered call ETFs and the options market. So if that is what you're looking for, please stick around. Mike Khouw, thanks for joining me. For those that may not know, Mike, you are a CNBC contributor, the author of The Options Edge, former partner at Cantor Fitzgerald, and a graduate of Tufts. And we could go on because I pulled it all up here. But now you're a strategist for YieldMax. So why did you decide to make this move and join YieldMax?
So it's interesting. One of the people that I worked with in the options industry, the founder of a company called Dash Financial Group, which is actually one of the largest algorithmic trading platforms in the world right now. And he's more active in the crypto space today, but he was getting questions, and I was getting questions about MISTY, the MicroStrategy covered call ETF that YieldMax has. And, we decided to just do a video about it. And, I was rather intrigued by what they were doing. And in any case, it turns out that some of the folks at YieldMax were watching the video that we created. It was Scott Snyder and Jay Pastorcelli were watching. Jay and Scott and Mike Venuto have all had this idea of sort of radical transparency, where they are, willing to talk to investors and pretty much anybody about anything related to the fund's activities, the strategies, and they do this all the time. That's a real positive. The downside was that they were kind of running out of bandwidth to do this because in the midst of all of that, Scott still has to handle the trading. They have other responsibilities, and they did not want to cut back. And they just wanted the firm to be even more available than it had been. And they just needed some extra people to be able to do that. And I guess because of the video that I did, they thought, well, Mike has a background in options trading, and he seems to understand what we're doing. You did not mention that I also have some experience in the ETF space as well. So I have traded over-the-counter derivatives, so some of the things like swaps I'm also familiar with. And, I guess there's not a huge number of people that have sort of all of those things, have been involved in the ETF business, have traded both OTC derivatives and extensive listed options business experience, managed money. So they thought I might be a suitable spokesperson. So, and look, truth be told, there are few sound sweeter to me than that of my own voice. So spokesperson sounds pretty good to me.
Yeah. Well, I think you're a good pickup. Let's put it that way. Now, you've only been with YieldMax for a few weeks, but with your background in the options market, I guess give me a few brief thoughts on some of the more popular funds. I'm thinking YMAX, ULTY, and SLTY. And don't worry, I do that all the time myself.
I've done it on CNBC countless times. You always get that look from the host. What are you doing? I mean, the mics are on.
Yeah, so just a couple thoughts on the more popular funds, YMAX, ULTY, and the all new SLTY. I guess SLTY is what they're called.
Mm-hmm. So, the single name, I mean, obviously there's considerable assets in many of the single name products. Those products are driven largely by investor interest. That is to say, if you're wondering what kinds of stocks would maybe be interesting candidates on the single stock side, you can kind of look and say, okay, well, what single stocks already have considerable options volume? The way I describe it is, you're walking down the street and there's a bunch of restaurants. You're trying to figure out which one to go to. Look for the one that's got the line that goes out the door and around the block. Without knowing too much else, that people care about that. We know that people care about Tesla options. We know that they care about NVIDIA options. And we know that they care about MicroStrategy options because that's what they're trading. As it happens, those are higher beta names, which means that there's higher implied volatility, that the options premiums are going to be higher. And for strategies that sell options premium, that's obviously an important consideration. The funds that you're referring to, like ULTY and SLTY, are different in a couple important respects. First of all, in this case, the fund managers are making the determination about the underlying stocks that they are trading, rather than customers choosing it. So Misty is the long MicroStrategy covered call, and Winter is a bearish tilt, also looking to collect options premium on strategy. Whereas ULTY is a generally bullish, diversified fund. Also, those strategies have a little bit more flexibility with what they can do. So you're dealing with a collared position there. So with respect to things like hedging, and actually they repapered the prospectus, the documents for ULTY earlier this year, and that introduced still more flexibility. It was around that actually took place at the same time that the distributions went to a weekly schedule, but I would say that the performance of ULTY since that time does not relate only to the distribution schedule. It also has to do with just giving more flexibility to the managers to do what they, at their discretion, think is the best thing to do at that moment. And the results, I think, kind of speak for themselves. ULTY has performed very well. It's when I look at the suite of products that are out there, it's one of the ones I would probably encourage people to look at if they don't know what stocks to look at, right? Stock picking is a hard exercise for anybody.
Sure.
Look at the SPIVA reports and see how many long managers are beating the S&P consistently over time, and you'll find that it's not a common thing to do that year after year after year, and that's because picking stocks is difficult. So the diversified funds, sort of take care of that situation, I guess.
Yeah, so I look at YMAX, and it's up about 30% over the last year looking at total return.
Mm-hmm.
The yield, however, is around 55%. And ULTY is also up around 30% year to date over the last 52 weeks. The yield for that one's around 85%. So one of the questions I get a lot, with many of the YieldMax funds, they've decided to go this route where they make distributions that often go well beyond the total return of the fund. So
for a given period, yes, that's right. Mm-hmm.
Yeah. So does this yield really have a purpose? Shouldn't investors really be looking at total return as our measuring stick?
Total return is the measuring stick that you should be using for the investment you make in any asset, whether it's a stock, a fund, or our funds, right? I think that's the important thing. I just pulled up YMAX right now, and I'm just looking at a 1 year look back. So September 18th of 2024 to present. If one had bought YMAX and reinvested all of the dividends, you'd have a total return of about 32%. If you had reinvested none of the dividends and instead just put those into a risk-free rate bearing account, which at this moment is about 3.97%. And in fact, actually, the overnight rates had been higher. The overnight rates have declined a little bit, but that's actually a look back using today's risk-free rate as an assumption. Then the 25% is a pretty good estimate of what the total return has been for the period. When it comes to distributions, there's a couple things that we need to bear in mind, and that is that registered investment companies, to have their tax treatment as a pass-through, have to distribute 90% of the income that they get
right.
from And the derivation of that income can be several things. If it's a diversified fund that actually holds the underlying assets, there could be dividends on those stocks. There could be interest that we are receiving on cash and cash equivalent balances. There can be capital gains, of course. And remember that in those instances where you're dealing with funds that have synthetics, those capital gains are going to come in the form of what's going on with the underpinning long call and short put if the underlying asset rises. And then, of course, you have the premium that's being collected from the short options. And, the managers are, number one, trying to maximize the real-time yield, recognizing that investors who are in these are able, if they choose, to, reinvest a portion of those distributions if they want, and don't have to if they don't want to. So essentially, that's being put into the hands of the investor. To the extent that there is any return of capital, the nice thing about a return of capital is that, at least in the near term, it is not a taxable event. That's not to say it doesn't have a taxable consequence. I'm not providing tax advice, by the way. And of course, depending on if, when, and how you're making an investment into these products, it's going to be unique. I live in a high tax jurisdiction, and if I'm doing that in a taxable account, that's my circumstances are going to be very different than somebody who lives in a low tax jurisdiction in a state that actually doesn't tax capital gains, or if you're doing it in an IRA, self-directed IRA, or in a Roth IRA, for example. That's also going to make a big difference. But our view on this is that people are looking for more frequent and higher distributions, and if they want to reinvest a portion of what they receive, they can do that. But the total, to your point, ultimately it's the total return that matters.
Now, with any distribution, the NAV does decline. It does drop. And a term that I hear a lot getting thrown around is NAV erosion or destructive NAV, where the distributions exceed the growth within the ETF. So is this something that an investor should be concerned about with an ETF like those from YieldMax? Because it's often discussed. You hear it all the time.
I think the reason that this is discussed is because when people are imagining what their ideal investment might look like, they're imagining that they could, invest in some asset, that the value of that asset would, stay steady or hopefully appreciate, maybe in a linear fashion, but also pay regular distributions, right? We are trying to navigate several different things, including, the potential tax consequences of, how these things are handled each time. And we're trying to basically deliver the best total returns net of taxes. Every single time a security is issuing a distribution, and that's true for a fund, but it is also true even for a stock. If a company issues a dividend, you'll observe that, all else equal, the value of the share will decline by the amount of the distribution on the ex-dividend date. That people should expect that here. So the question they should ask themselves at that point is, what difference does it make to me if the distribution is larger or smaller? If it was smaller, the value of the share would not decline by as much. But if the distribution is larger, the investor has the option to reinvest a portion of it. And our view is that the benefit of these products is that people have that in their own hands. I was talking to somebody recently who, is invested in several of these. And, in his particular case, he's established that, because he's actually retired, he's established that he needs to take about 8% of his capital in distributions each year to meet his living expenses. Beyond that, he reinvests everything else. And if one were doing that in any of these, you would still be doing quite well. I mean, in YMAX, if you were taking out at an 8% rate, and like we said, it's 25% year to date, we are, near enough as it makes no difference. We're pretty close to 3/4 of the way through the year. So if you were looking at taking out 8% a year, that would suggest that you have used effectively 6%, right? And that would mean on a 25% return that you'd reinvested 19%, if that was the sort of the method that you were following year to date. So, every investor is going to be in a different set of circumstances. Some will be in reinvesting all of it, some none of it, and some somewhere in between. I don't know what everybody's needs or demands are, but I think it's better that we leave that in their hands than in ours.
Now, I would say a covered call is a hedge as much as it is a potential income. So if I sell a call, right, it should reduce my beta versus the underlying. I would expect that my alpha would reflect this reduction in volatility as well. So with that in mind, will we ever see outperformance from a covered call ETF over an extended period of time versus the underlying?
You can. It depends. I guess one important thing to think about is that when you're dealing with covered calls, the hedging component is essentially the premium that you're collecting, right? And if you're selling short-dated options, while they decay more rapidly, and the annualized rate of return, therefore, will appear higher, the absolute amount of premium that you're collecting relative to the value of the underlying asset is necessarily lower. One's intuition should suggest this would be true. If I have a $100 stock, I sell a 105 strike call that expires in a week. That 1 week call is definitely going to have a lower premium than one that expires in a month or a quarter or a year. Now, the downside, of course, for those who are seeking really regular distributions is that if you sell really long dated options, how are you going to take those distributions without actually unwinding the underpinning securities? If you're selling covered calls every week, well, at the end of that, after 1 week's time, those options have indeed expired. So you can distribute some of what is in the fund, and you can redeploy again against the long equity position. On the other hand, if I sold a 1 year call, the only way to make a distribution after a week or a month or a quarter is to actually unwind some of that call and unwind some of that stock. It's the only way that could be done. So, these are the way I like to describe this to people is, you're squeezing a balloon of risk and reward trade-offs, depending on what strike you decide to sell, which tenor. In other words, what maturity, how many days to expiration option you're looking to sell. And, the impacts that's going to have on the daily performance of the underlying assets is going to be different. I don't even know if there's a mechanism to share screens, but I could illustrate that pretty easily because I happen to have a slide for another presentation that showed what a 20% out of the money call on MicroStrategy initiated at the beginning of this year would have returned so far this year had one done it compared to the stock. And you would have had lower drawdowns, much lower volatility, and considerably higher total returns. AMZY, which is doing short-dated covered calls on Amazon, it behaves a lot more like the underlying asset because you're collecting smaller amounts of premium more regularly rather than a big chunk that expires a long time out. At least when I looked at this through, maybe it was last week or so, its total returns year to date were higher than Amazon. Its worst case drawdown was lower than Amazon's, and its volatility was lower than Amazon's year to date. So can that happen? It can, and it does. But I don't think that people should look at these strategies in exactly the same way. An example I was thinking about recently is that if you think about a bank extending auto loans and an insurance company underwriting auto insurance, both of those financial institutions are looking to make returns where there is an underlying asset, the car, right? And both of those institutions have financial products that are probably better off in the long run if the value of those assets increase, right? If a bank loans money on cars and all of those cars just became worth more and more money, they would never lose. Why is that? Because they could always repossess the car and they'd have an appreciated asset. So they would never lose. If if the value of the cars constantly increased for the auto insurer, irrespective of what may or may not have happened to them, they also would probably be better off. If somebody insures a $50,000 car, but suddenly it became worth $500,000, even if the thing was totaled to pieces, will almost certainly be worth considerably more, and they'll basically have just collected the premiums for nothing. When you do covered call strategies, you are engaged in in an investment that it's kind of a hybrid, right? It has exposure to the underlying asset, and the value of that asset matters, and you're always going to be better off if the value of that asset increases. But in much the same way that a car loan doesn't exactly track the value of cars, and in much the same way that how well Progressive and Geico do selling car insurance isn't necessarily directly tied to the value of the underlying cars, I think that's one way to think about it here. And to maybe put a finer point on that, take a look at all of the YieldMax strategies and how they've done year to date, right? So year to date in the S&P, I think 68% of the constituent stocks in the S&P are higher so far this year, with an average total return of about 8.5% from the end of last year to now. Excluding the short strategies for YieldMax, those numbers are probably closer to 80% and 15.6%. Did some of the if you're only comparing the single stock covered call to the underlying stock, I don't know that it is an important consideration, but it's not the only one. And, so I think it kind of speaks to the merits of the strategy, but, just bear in mind that if you're selling off the upside of an underlying asset, which is what selling a covered call is, that means you're not going to get the upside above the strike where you sold it. That's, it should be self-evident. I hope it is. It's similar, but not the same.
All right. So that's just a simple covered call. So let's take this idea a step further. So mispricing in the options market. So does it exist in your opinion? Or, for me, I'm an engineer, right? So do you follow the efficient market hypothesis and think we can toss out technical analysis? I guess what I'm trying to get to is, an option-based ETF that continues to get more complex and offer active management, more flexibility, right? So they've got more flexibility now with ULTY, for example. So do you think these more advanced funds will eventually provide better performance and possibly real alpha?
Well, I will say that one way to think about what a fund can achieve, what it does achieve, we'll leave that apart, right? So there's a lot of funds out there. There's a lot of fund managers. But I think it is reasonable to assume that in an ideal world, greater flexibility offered to the fund manager should yield better results. And the way to think about that, from my perspective, is that if you take a portfolio manager and you tie one hand behind their back, it's a tougher fight. Doesn't mean they can't do well. I don't want to get into a ring with Floyd Mayweather, whether he's got one hand tied behind his back or not.
Yeah.
But he's going to take me out a lot faster with two hands than he will with one. So, I mean, personally, where options are concerned, now bear in mind that, my background is options trading. That's how I got my start. And, there are a lot of different opportunities that can arise in the options market that you can use to make money. The term structure might not be shaped the way you think it should be. Skew might not be shaped the way you think it should be. The relationship of options in general, the price of them, how much volatility they imply for a period going forward, may differ considerably from what you actually expect the realized volatility to be. That's its own kind of an opportunity. And then, also importantly, how do the prices of options on one underlying asset compare to a related asset? If you could, for example, just take a look at the price of all of the options on stocks in the S&P and compare them to options of the S&P, SPX options, SPY options, and so on. So, there's a lot going on here, but I guess the simple answer to part of your question, which was, do I believe in the efficient market hypothesis? I believe that in the long run, security prices can sort of converge to their value. But I also believe that in the short run, they very rarely reflect it. I think the most common sort of statement that people have made about this is that, perhaps it was Buffett or somebody like that who made this remark, but said that, in the short term, the markets are a voting machine, and in the long run, they are a weighing machine. In the short run, and most of us, when it comes to trading, are trading in the short run. We're not going 100 years out. There's definitely things that are mispriced. Improvements in technique, improvements in technology have probably accelerated the amount of time that it takes for a security that diverges materially from where it should be priced to from where it is. It probably can shorten that time, but we are not in an efficient market here. You cannot look at the entire universe of stock prices and say every one of those is exactly where it should be. And the reason is because it is exactly where it should be right now, based on basically the consensus view that all investors who are actually deploying capital to the markets at this moment have arrived at. And that would be to say that that's an efficient market would also mean that those opinions will not change. But they change from not only day to day, they change from 1 minute to another. Mm-hmm. You would not see intraday volatility where it is if the market was really efficient. There's all kinds of things that are going into it. So I think it's ultimately efficient, but instantaneously, no.
For people that are looking for more option content, you've got Open Interest. That's your YouTube channel. You go live on there quite a bit. And if you want to go into a lot more depth with options, check that out for sure. So now for the retail investors that are out there just listening right now, what do you see are some of the use cases for some of your funds like YMAX, ULTY, and SLTY that we started talking about? And do you think that these are the types of funds that you can just buy and hold in your portfolio?
Well, I think actually you kind of addressed this question almost from the very outset, which is, typically buy and hold investments. What's an example of a buy and hold investment? Berkshire Hathaway, I think, would probably be, almost one of the ultimate buy and hold investments out there. And it's a core tenet of those that have managed it. It was a core tenet of Charlie Munger's, and it remains a core tenet of Warren Buffett and his successors. That is their philosophy. Consequently, Berkshire doesn't pay dividends, right? Mm-hmm. So if something makes distributions, anything that makes distributions is not a set and forget investment. In the same way that when a bank decides to issue, in my previous example, a car loan, you issue a 48-month or a 60-month car loan, it's not like the bank gets to do that one time and then, everybody gets to go home for the rest of their lives. That capital, as it comes back, because it is distributed back to the bank in the form of payments, that capital has to be reinvested. It has to be redeployed. If you are a fixed income investor, a bond investor, the same thing applies. You are taking distributions. You have to make a determination about what to do with those distributions, and you may indeed need to reinvest them. These are funds that make distributions, sometimes very big distributions. So it's not set and forget in the same way that investments that don't make distributions are. What's another perfect example of arguably a set and forget? Gold. Gold does nothing. I think Warren Buffett was actually the one that said it does nothing but sit there and look at you.
Yeah, it doesn't.
Right? If you decide that you want to be long gold because you also believe that fiat currency is going to be debased over time, which is fairly true in human history. Governments have a history of debasing money. well, then maybe you want to hold gold or some other precious metal as either a hedge against that or as a store of value. That can be set and forget. But almost any other investment that has any kind of a distribution doesn't behave that way. Real estate, people invest in real estate for income. Is that set and forget? Not that I've ever seen, because you have to make an investment back into the property. You know, what happens to that property over time? You know, you have to maintain it. So that requires time, attention, and it requires reinvestment. So, you know, when you're looking at any investment that throws off distributions, reinvestment is a risk. The flip side of that is that investments that make distributions are oftentimes less risky because they're making distributions. If you said, hey, you know, I have a great investment, just loan me some money, and it's going to be a 0 coupon bond maturing in 50 years. Well, a 50-year 0 coupon bond has material risk because you are not receiving any of your capital back there, and that makes a difference too. So it's one of the reasons that Peter Lynch, people who are familiar with the PEG ratio, may be less familiar with the PEG-E ratio. That was sort of something that Peter Lynch, who was the famous fund manager at Fidelity Investments back in, I mean, before I got into the investment world, that's for sure. I think it was the 80s, and I don't even know if he started in the 70s, but it was the 80s and maybe the early 90s. You know, he actually would add the yield, the distributions, back to the growth rate for his calculation, because in his estimation, something that actually made distributions was more valuable than something that grew at the same pace but did not. And I would agree with him. So, set and forget? No, because you're taking distributions and you have to establish what you're going to do with them. And that obviously is a little bit more hands-on.
All right. And finally, this is my just for fun question for you. So over on CNBC, you guys have your annual acronym challenge, and I believe you were the victor in 2024. Mm-hmm. In 2025, you came out with Rising, and I'll put a picture up here now showing those picks. But Rising was RSP for the equal weight S&P 500, mm-hmm. IBIT, proxy for Bitcoin, SCHH, which is a REIT ETF. You had a bet on India with INDA, NANCE and ANC, which I actually recently reviewed that ETF, based on selections by Democrats in Congress, and then Google with an L because you like to vote. Yeah. So my question is, if you had to invest $100,000 right now, you get a chance to double down on Rising, where would you be putting it?
On any one of those constituents, or on Rising itself? On
Rising itself. Within Rising, which one would you pick right now?
So, I want to throw one other thing out there. Folks who watch the YouTube channel will know this, and I think I mentioned this to you in an email. So, when I was asked to participate in the acronym challenge for 2025, my first acronym that I sent them was Bond Vigilantes, and the producer said no. No, you can't. They're like, that's way too many letters. You're going to be on the show the whole time explaining what each one is. Not allowed. So I said, okay, then it's Rising with 2 G's for all of the names that you just pointed out, plus GLD. Okay. And GLD, by the way, is related to, so my prior year's acronym, which was BRAVE, included B for Bitcoin and A for AU, which is one of the gold miners, Anglo Gold Ashanti. Because I have been bullish on gold and I have been bullish on crypto for several years. And anybody watching us right now probably got a sense of that when I started talking about the history of government and monetary debasement. Yeah. That's a hint of how I fall on these issues. So, and I discussed that my actual shortened acronym was Rising with 2 G's, but the producers also clipped off the last one, because they said you're capped at 6. You're not allowed to have more than 6 letters. You know, to be honest, I rather like all of these. Okay. Still, the one it's probably easier for me to say which ones I would ditch than which ones I want to keep, because I pretty much like all, except that I would probably ditch Nance and I would ditch SCHH. Bear in mind that when I came up with this, I had no affiliation with YieldMax at the time, and I would never choose at this point an income producing ETF that wasn't part of our fund family.
Okay.
And so I would probably replace that S with ULTY, but the acronym's just not that great, is it? That's the other thing about these acronyms. You need a certain number of consonants.
Yeah, you gotta have some style with whatever you're spelling out there, right?
Yeah, so maybe maybe I could put a GPTY in there, rigging. Although I need another G. I could actually get rid of Nance. So my new one is rigging. How about that? So now I've still got two G's. So I've still got my alphabet, and I've still got my and I could probably actually ditch alphabet and put GPTY in there. So I'll swap that out. I think that's kind of an interesting play on AI. The thing about the AI names, and the reason I rather like them, I like the diversified funds, but the other reason is that these things are probably going to maintain relatively high levels of implied volatility. So from an income perspective, the other thing is, look, I mean, since Labor Day, we've actually seen a little bit of an uptick in implied volatility. We'd basically been sliding, especially in the back half of the summer, July and August. Big declines in implied volatility and everything from strategy to NVIDIA and pretty much across the board. It's a seasonal period where historically implied volatilities have risen, Sep, Oct, and Nov. October is typically higher than September, which is a above average month in terms of implied volatility, and November too. I think probably people wouldn't have expected that. Because you have the holidays upcoming. That's usually a strong period for equities, and November is a trading day shortened month. I mean, first of all, it's just 1 day shorter anyway, and you lose a day and a half because of Thanksgiving every year. Close Thanksgiving, half day of trading the Friday following. So you would imagine that volatility would typically be lower, but surprisingly enough, it isn't.
Yeah, well, I thought it was interesting yesterday after the rate cut. I see all the stocks dropping slowly, and the VIX dropped like 5% all of a sudden. I mean, just the announcement itself, and the VIX went down 5%. I thought that was an interesting reaction.
That's the event variance.
Yeah,
that's the event variance coming out. So generally speaking, people should, whether you're looking at these strategies or you're looking at the market in general, I'll just leave you with this one thought. You'll observe this all the time, that the value of options that capture an upcoming event will tend to see their implied volatilities remain stable or rise until that event.
Mm-hmm.
And the reason for that is that there's an underlying volatility process, sort of what the stock does day to day. And then the options market's baking in this little bit of extra, that event variance, what they expect that the additional volatility that the event could do. And the next thing that happens is what we call the vol crush. What is the vol crush? As soon as that event comes out, and everybody's found, then instantly that little extra padding that has been built into options prices to accommodate that anticipated event gets sucked out. With one exception, actually, Oracle. I kind of saw this after their earnings. They didn't get the vol crush one might normally have expected. That was a really juicy post-earnings vol sale. I was very, very interested in that. I thought, wow. I mean, one of the problems with being in the on the institutional side is that you can't just start, fooling around with your own money all the time. But that was one that stuck out to me, and I was thinking, boy, would I really like to lean into that on the short side.
All right, Mike. Well, thanks so much for sharing your knowledge with us here today. I do appreciate it. Hopefully, we can do this again in the future. Catch up at a later date.
Be happy to.
Thank you.
Yeah, I appreciate the invitation.
All right, that was a lot of fun. I like talking to people like Mike. They've been in the industry for a long, long time. They've got lots to share, and we have a lot to learn from people like that. So it's a good pickup, in my opinion, for YieldMax. Now, if you have any questions on any of this, please ask down below. If you'd like this type of content, like and subscribe, and I'll see you real soon. Have a great night. Whoop.